Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. I am excited and pleased to have with me a special guest for this week, Sam Rines, our Macro Strategist at Wisdom Tree. Sam, great to have you on board.
Oh, always a pleasure to chat, Kevin.
I mean, think about this, right? We got the first month of 2025 in the rearview mirror, but the last 2 weeks, or shall I say, the last 2 days have been chock full of headline making activity. And what we wanted to do is just give everyone a little bit of a sense. Like we're calling this Trump, Powell, and rates and looking ahead. So, Sam, I think without further ado, given where we are current event wise, I want to swing it on over to you because we do know, in Trump 2.0, we've already seen the president is once again not going to be refraining from offering his thoughts on what the Fed should do, lower rates. But there's also so much more to the equation than that. And obviously, the news over the weekend, the news as we go into this recording, I mean, it's just going to remain fluid. I think you would agree with me on that. So, let's start with the tariffs. Let's talk about some of these executive orders. What's going on down there in the nation's capital?
Well, it's incredibly interesting because for the first couple of weeks of the administration, we were very focused on the executive orders around trade, around energy, how we were going to react to those. What did they mean for the domestic economy? And you and I chatted frequently about it. And it was really a lot of infrastructure building. It was a lot of focus on natural gas. It was focus on Alaska, good for our Asian allies when we produce more energy on the West Coast. There were a lot of these undertones. Then we get into this past weekend, and it's all about tariffs. It's all about 25% on Mexico and Canada, 10% on China. How is that going to affect the U.S. economy, their economies? How is that going to relate to the dollar, inflation? How is it all going to bend back towards what we do, which is, try to figure out how to position moving forward, whether it's rates, whether it's, currencies, whether it's equities. There's an effect that really just goes through everything. So it's been incredibly intriguing to see just how quickly this has moved. And then the Trump administration is likely to focus on the European Union. All of those are going to, again, they're going to influence equities. They're going to influence rates markets. It's simply going to be vol, and more vol.
I think it's a fascinating aspect to this that we've had Powell continue to talk about the Fed's monetary policy decisions being data dependent. And now, you're getting the sense they're policy dependent and how they're almost reactionary, waiting to see how this unfolds as well. But, a lot of other people don't wait to see how these unfold. And I wanted to ask you this question because I think it's an important one to try to put it into perspective for people. So, before the news came out, on the Mexico side of the equation, the pause, say, for the next 30 days, everybody seemed to be putting out their estimates for GDP. What's this going to do for core inflation? Are they out in front of their skis, do you think, on that? Do we need to just sit back and let this play out? Or are there other things to think about, say, supply chains? We come out of COVID. Have things shifted so that maybe we need to take a step back before we say GDP, there's going to be a 0.4% drag or something like that?
Oh, 100%. It's really take a deep breath and wait a minute. I really think it's worthwhile just taking a deep breath. I call it the take a sip of water before answering the question rule. And it's very difficult to figure out what does a 25% tariff that may or may not be delayed with our number one import partner, Mexico, and our number three import partner, Canada. How is that going to affect GDP? How is that going to affect inflation? Well, it really depends, one, how long those tariffs are imposed, and two, who is, not prepared for it. And we've had, if you go back, 6 years, you had 2018. That was the U.S.-China trade skirmish 1.0. Then you had COVID. Again, disruption to supply chains. Companies had to reconsider that. Then you had the Russia-Ukraine conflict. Again, that forced companies to look at their supply chains all over again. So you've had three consecutive shocks to supply chains, and the notion that it's the same as it was is simply false. So I do think we need to step back, take a deep breath, and figure out what really matters, how long it's going to be, and what the guideposts are for understanding the effect, particularly when it comes to the Fed, because the Fed is going to take a deep breath. They're not going to be reactionary. They're not going to jump over their skis. They're going to wait for the data to come in. And frankly, the data that's probably more important for them is going to be the numbers that we're hearing out of DC when it comes to shrinking the federal government. That could be 150 to 300,000 employees over the next several months. So it's likely that you're going to see some of that matter more in the near term than the potential for tariffs and tariffs themselves.
So that's great. So I'm glad you brought that up, because I wanted to ask you about that. The 150 to 300,000 government employees. What would happen if they do leave? So I mean, is this something that you would expect to see show up in future jobs reports, kind of one for one? Do they seasonally adjust it out a little bit? I mean, or is this going to be, we could have a couple of employment reports where we see some shocks to the system here, especially in terms of government employment?
It's difficult to tell, mostly because the U.S. government employees are going to have severance until September. At least that's what we're being told right now. That gives them time to find a job. And 150 to 300,000 people sounds like a lot, but this is an economy, the U.S. economy, that has 3 million people, give or take, quit their job a month. So there's the ability for those to be absorbed over time. If you were to just dump the entirety of the U.S. government, direct government employees onto the unemployment rolls, that would be very significant. That's about 3 million people. So that's about a month worth of quits. It's about half a month's worth of hires. So I do think that there is likely to be a little bit of risk on the government employment line, but it's likely to be significantly mitigated by a rather vibrant employment market under the surface. It's not as though U.S. businesses have decided to stop hiring. It's not as though job openings have disappeared. It is something to keep an eye on, but it's probably less of an issue for the Federal Reserve than I think it could be potentially.
So, one, I think, important thought on this. We're talking about things that are kind of happening in the here and now on the government side of the equation with respect to the executive orders, the tariff announcements. What about let's look ahead a little bit for this year. Specifically the Trump tax cuts. There were a lot of headlines that said, wow, tariffs came before tax cuts. What about those tax cuts? What should we be thinking about that as we move forward further in the months ahead here in 2025?
The tax cuts could be substantial, particularly when it comes to sentiment. I think that's a really overlooked part of what tax cuts really are. They're a sentiment booster for people and businesses who are spending and investing. So I do not think they can be overlooked. There's a good chance that you get an individual tax cut, particularly for the middle class. There's some probability that you could have a tax cut for corporations or some shifts in the corporate tax code. That's going to be a little more difficult simply because you could have more pushback from the Democrats, and you could have some GOP pushback as well. There's some chance that you could have the tax on buybacks removed. That would be a significant booster for corporate sentiment and probably valuations on some businesses. So while there's a lot of question marks around what it's going to look like, I do think we have to pay attention for that because it could be a demand side boost to the economy, right? Demand picks up and you have tariffs potentially playing with the supply side. So you could actually have that really be the impetus for inflation to be somewhat precarious in the back half of this year.
So, I think wrapping this up, I think a main theme from all of this, Trump, Powell, et cetera, is that, at least from my perspective in the fixed income arena, and you alluded to it as well, we expect to see continued volatility in the Treasury market, overall yields remaining at what we call, quote unquote, normal elevated levels, even if the Fed does cut rates again later this year. And for us, what we've been talking about, our preferred fixed income strategy to try to navigate all of these waves that seem to be coming our way, and will no doubt continue to more than likely come our way, is our active passive barbell approach, where we think, the cornerstone of looking at Treasury floating rate notes being the passive part, and marrying that or aligning that with an active type of ETF solution on that front for fixed income is the way to make sense. So I'm going to end it there. Sam, it was great having you on. Hope to have you on again.
Always a pleasure, Kevin.
Take care, everybody, and be well.